Welcome back to Investing Talk Podcast.
Today we're looking at Lululemon. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone watching the stock market, Lululemon has been a tough one lately.
Tough is maybe an understatement.
Yeah, I mean, this isn't just a small pullback.
Yeah.
The share price has absolutely plummeted. We're talking over 50% year to date.
Wow. For a brand like Lululemon, known for being so premium, growing so fast, trading near multi-year lows just feels, well, wrong.
It feels totally out of sync, doesn't it?
Right.
And that massive drop is why we're asking the question today, is it time to buy?
Right. Has the market just completely overreacted here? Is the pain already baked into the price? Because the headlines, they're pretty negative.
Oh, they are loud and clear. The real turbulence, it sort of peaked around that Q2 earnings report back in September.
Yeah, I remember that. Investors were maybe expecting things to slow a bit, but management, they dropped a bit of a bombshell, didn't they?
They did. So interestingly, they actually beat the EPS consensus. Came in at $3.10.
Okay, so far so good.
But then they cut the full-year revenue and profit guidance. And, well, cutting guidance happens, but the market reaction was severe.
17%. The stock dropped over 17% just like that.
Exactly. And it wasn't just the numbers, it was the why. Management mentioned margin worries, and specifically they called out tepid U.S. trends.
Ah, okay. That's the phrase that probably scared everyone. Fear that the main engine, the U.S. market, was sputtering.
Precisely. And that just set off a chain reaction. Analysts jumped in immediately, downgrades everywhere.
Right. Zacks moved it to strong sell. I saw Redburn cut their target way down.
Yep. And then for the chart watchers out there, technically, the stock just couldn't hold. In October, it closed below that key 50-day moving average, around $178.50.
Which is just confirmation for many traders that the trend is down. Sell, sell, sell.
So that's one side of the coin. The market screaming, get out, based on guidance, margins, technicals.
Yeah.
But here's where it gets interesting. And this is really the core of our analysis today. That narrative of a failing company, it just doesn't quite line up with the fundamental performance, even in that same quarter.
That's the disconnect, right? The stock action versus the actual business health.
Exactly.
Yeah.
And that disconnect, that might be the opportunity.
Okay, help us bridge that gap, because down 50%, that usually signals real trouble. But you're saying the business itself is, well, okay.
More than, okay, actually. Let's look at those Q2 numbers again. Net revenue was $2.21 billion.
Which was up 15% year over year.
Right. Now, maybe 15% isn't the hyper-growth people got used to, sure. But compare that to almost any other big retail brand right now.
Yeah.
That's still really solid growth.
So people are still buying the product, demand isn't collapsing?
Not based on that number, no. The
Yeah.
consumer is still definitely buying Lululemon.
And they're not just giving it away to hit those numbers, right? What about profitability? Margins?
That's the other key point. Their profitability is, frankly, exceptional in the apparel world. Operating margin, still strong at 20.4%.
20%? That's huge for retail.
It is. Think about their competitors. That kind of margin shows they still have serious pricing power. They aren't relying on deep discounts.
Okay.
And look at EPS, earnings per share. That actually accelerated, $2.32, up from $2.01 the year before.
So revenue's growing solidly, margins are best in class, profit per share is accelerating. Why on earth did they cut guidance so much that it tanked the stock by half? This is the puzzle.
And the answer, it seems, lies almost entirely outside of whether you like their aligned pants. It's external, regulatory stuff, trade headwinds.
Market demand weakness.
Not primarily, no. The big hit to those forward margins that management flagged. It's mostly about rising tariffs and, crucially, the end of something called the de minimis exemption.
Okay, de minimis. Let's unpack that because it sounds technical, but you're saying it has a massive dollar impact here.
It's critical to understand this, yeah. So, de minimis, historically, let companies bring small packages into the U.S., think items under $800 value without paying import duties. Minimal customs fuss.
Right, which for a company maybe shipping directly to consumers from overseas factories, that's a big cost saver.
Huge, especially for apparel, fast fashion, anything using that direct model. They could basically avoid duties on a lot of individual shipments.
And now that exemption is ending.
Correct. Or being significantly curtailed. So Lululemon now faces having to pay duties and tariffs on way more of its imported goods.
And they put a number on that impact.
They did. They estimate this shift alone will shave about 220 basis points off their gross margin and the dollar figure. around $240 million in lost profit in fiscal 2025.
$240 million. Okay. That explains the guidance cut.
It explains a huge chunk of it, yeah. It's an accounting and tariff hit. It's not necessarily because fewer people want to buy their stuff next year.
That reframes the 50% drop completely. The market may be panicked about a margin squeeze, not a fundamental business collapse.
That's the argument, yes. It looks like an overreaction to what might be a significant but potentially manageable cost issue, rather than a sign the brand itself is failing.
Okay, so if the panic was overdone, let's talk about the underlying strength. You mentioned tariffs require cash to manage. How's their financial position?
It's rock solid. Really strong balance sheet. They ended Q2 with $1.21 billion in cash.
And debt.
Only about $492 million in total debt. So loads of cash compared to debt.
Which means they can handle that $240 million tariff hit without, having to scramble for cash or slash vital investments?
Exactly. They have the cushion. They don't need to panic. They can invest through this period.
And they're not just sitting on old cash. They're making tons of it, right? Free cash flow?
Oh, yeah. It's a cash machine. Trailing 12 months, free cash flow was $1.16 billion.
That kind of cash generation is huge in retail. It lets them invest where others maybe have to cut back.
Absolutely. New stores, digital stuff, product development, they can fund it all internally. That SCF is a massive competitive advantage.
And that cash supports what you could argue is their main advantage, that incredibly strong brand. You mentioned NPS earlier.
Right, Net Promoter Score. Theirs is above 70.
Which is really good.
It's phenomenal. In retail, anything over 50 is considered excellent. 70 is like cult status level loyalty.
So customers aren't just buying, they're advocates. They love the brand.
They really do. And that loyalty, that's what lets them charge premium prices and avoid getting sucked into constant sales cycles like so many other brands. It insulates them.
And they're using that strong brand base to push into new areas, aren't they? Footwear, men's apparel.
Key strategies, yeah. They're not just sitting still. They're actively trying to grow their total addressable market, reaching beyond that core women's yoga base.
So, okay, fundamentals look strong, brand is killer, balance sheet is solid, even with the tariff hit.
Right. So the next logical question is, has the stock price finally found a floor? And does the valuation look attractive now after this huge sell-off?
The technicals were ugly for a while, like you said, breaking that 50-day average. But are things looking better now?
There are signs of stabilization, yeah. If you look at valuation metrics like discounted cash flow models that analysts use, the general consensus is that the stock looks pretty cheap relative to its intrinsic value, maybe around 33% undervalued.
33%? That's a significant potential upside, a margin of safety, as they say.
It is, and analyst price targets seem to agree. The median target out there is around $200 a share.
Which, from where it's trading now, is what, like 28, 34% higher?
Somewhere in that range, yeah. So analysts see significant recovery potential. And technically, we're seeing some positive signs too.
Like what?
Like the stock seems to be building a base. It's running in higher lows, finding support near that $175 level. And importantly, it recently got back above that 50-day moving average it broke earlier.
Okay, so maybe momentum is starting to shift back towards the bulls.
That's what those technical signals suggest, yeah. The panic selling might be over, replaced by accumulation.
And when a quality name gets beaten down like this, often for non-fundamental reasons, you sometimes see insiders step up. The execs, the directors, have they been buying?
They have, actually. That's another positive signal. Looking at the Form 4 filings from September and October, we saw about $1.2 million worth of purchases by directors and C-suite executives.
So management is putting their own money on the line, signaling they think it's cheap.
It's a pretty strong vote of confidence, yeah. Tells the market they believe in the recovery story.
And it's not just insiders, right? What about the big money institutional investors?
Also seeing positive flows there. Whale Wisdom data shows net institutional inflows of around $220 million since the second quarter.
So the big funds, the sophisticated investors with research teams, they're starting to move back in too.
It looks that way. They seem to be agreeing that the valuation's attractive down here and are positioning for a rebound.
Okay, so strong fundamentals, technicals improving, insiders buying, institutions buying. This brings us to the catalyst, right? What could actually drive the stock higher in the near term?
Exactly. And the next 3 months are actually packed with potential catalysts that could really shift the narrative away from tariffs and back to growth.
What's the biggest one?
Without a doubt, the Q3 earnings report that's due in early December, this is the big test.
What will the market be looking for?
2 main things. 1, signs that margins are stabilizing. that management is actually managing that tariff impact effectively. 2, an update on U.S. demand. Has it really softened, or was that Q2 comment just temporary cautiousness?
And management guided for $2.18 to $2.23 EPS for Q3.
Right. If they hit or beat that, and crucially, if their guidance for Q4 of the holiday quarter looks strong, you could see the stock move up quickly to close some of that valuation gap we talked about.
Okay, earnings is huge. What else?
Well, related to the holidays, you've got major product launches hitting in November, the expanded men's lines, and importantly, the newer footwear collections.
Oh, right, the shoes.
Yeah, those are expected to help drive what could be record quarterly revenue. Success there really validates their strategy of expanding beyond apparel.
Shows they can grow the addressable market.
Exactly. And then there's the international piece. While the U.S. might be tepid, growth in places like China and Europe has been really strong.
So diversification helps.
Big time. And we're expecting maybe some news before year-end about new market entries in the Asia-Pacific region. That reinforces the long-term global growth story.
Okay, and anything more? Speculative. Any buzz out there?
There is some chatter, yeah. Unconfirmed, mind you, but rumors about a potential collaboration with Apple Health, integrating Lululemon smart apparel into that ecosystem.
Wow, okay. That would be a big deal if true.
Huge. It would really cement their position as more than just clothing, moving into wellness tech. Highly bullish if it ever happens, but purely speculative for now.
Got it. So lots of potential positives lining up. But we have to talk about the risks too. What's the main thing that could derail this bullish case?
It really comes back to the U.S. consumer and the broader economy. The stock is still going to be sensitive to recession risk.
Meaning, if the economy really slows down, even loyal Lululemon customers might cut back on premium activewear.
That's the worry. Discretionary spending is often the first to go in a downturn, even for strong brands. So a deeper than expected U.S. slowdown is the primary risk here.
Okay, makes sense.
But when you weigh that risk against everything else, the fundamental strength, the cash pile, the brand loyalty, the improving technicals, the insider buying, and all these upcoming catalysts.
The balance seems tilted positive.
I think so. The market's panic over those tariffs seems to have created a real opportunity here. The risk-reward looks favorable.
So wrapping it up, it sounds like Lululemon offers maybe two kinds of opportunities right now.
I think that's a good way to put it. There's potentially a shorter-term trade opportunity based on these catalysts playing out over the next, say, 90 days. Earnings, holiday sales, maybe some positive news.
And then also long-term investment case.
Absolutely. Based on that secular growth trend, the global expansion, the innovation, and that incredibly powerful brand moat, it still looks like a compelling long-term hold, especially at this lower valuation.
The fundamental question for you, the investor, is whether the undeniable tailwinds from international expansion and highly innovative new product lines can overcome the immediate margin squeeze caused by tariffs and tepid U.S. consumer trends in the short term.